The second April tariff announcements did result in a spike in economic uncertainty. We saw a sell-off in risk assets, and on the back of that, we have adjusted our US GDP forecast for 2025 to 1.5%. Now, tariffs will have some impact on inflation as well in the US, and we have adjusted that to for 2025 to be at 3%. Now, unless the labor market significantly weakens from here, we anticipate the FOMC will likely hold rates until Q3 while evaluating inflation that comes on the back of tariffs. Now, a slower economy in the US will impact the rest of the world, especially those economies that are reliant on trade and manufacturing, but the overall impact will likely be mixed. Now, small open economies will likely be able to better deal with these effects through fiscal and monetary policies, especially if they do have that flexibility to adjust. And this is very important for FX because when we think about FX, we think about relative growth differentials, we think about relative rates, we think about relative impacts of global terms of trade. So the abrupt shifts in policy have led to a fall in confidence in the US dollar, and that's really been observed by the move lower in the US dollar and US equities, along with the shift higher in US yields. Gold prices have also benefited. Now, possibly we are seeing a little bit of a reallocation of capital across various currencies. The shift in European currencies has been a little bit sharper than what we've seen on the Asian front, but broadly, we do expect the US dollar to continue its decline due to fading US exceptionalism and also coming off that many years of US dollar overvaluation.